If you're over 50 with retirement savings, this video could provide valuable educational insights about a new asset class that's reshaping retirement planning. I'm going to share educational information on how some conservative Americans are exploring cryptocurrencies as part of their retirement strategy, not as a gamble, but as a measured approach to portfolio diversification. At Decentralized Masters, we focus on education about decentralized finance. In the next 7 minutes, I'll share educational frameworks that some investors are using to explore this space responsibly. Let me start with some realities about retirement in America. Many financial experts suggest that Americans need substantial savings to retire comfortably, but most people approaching retirement haven't reached those targets. The traditional advice of stocks, bonds, and savings accounts may not be generating the returns many people need to bridge that gap. This has led some investors to explore alternative asset classes, including cryptocurrencies, as a potential component of a diversified retirement strategy. Now, the educational framework I want to share isn't about chasing speculative returns or betting everything on volatile assets. This is about understanding how some investors are approaching cryptocurrency as they would any alternative investment, with careful consideration and proper risk management. When we study successful retirement portfolios, we often see certain principles. First, capital preservation remains the highest priority. Experienced investors typically avoid putting more than a small percentage of their total portfolio into any single alternative asset class. Second, they focus on assets that can generate yield or income, not just price appreciation. This means looking for a way to put investments to work for you, earning returns. Third, they diversify across multiple strategies and asset classes to reduce concentration risk. Let me explain how these principles might apply to cryptocurrency education. Some financial educators discuss cryptocurrency education in 3 conceptual categories. Foundational assets represent a small allocation to established cryptocurrencies like Bitcoin and Ethereum. These are often viewed as the digital gold and digital infrastructure of the crypto space. Historical data shows Bitcoin has delivered significant returns over long time periods, though past performance does not guarantee future results. For educational purposes, some advisors discuss allocations as small as 1 to 5% of the total portfolio to these established assets. Income generation involves using stablecoin strategies to earn yield on dollar-pegged digital assets. This educational concept allows investors to understand how they might earn higher yields than traditional savings accounts while maintaining stability of principal. Educational examples often discuss earning 5 to 12% annually on stablecoin positions, though these rates do fluctuate and carry some risk that must be understood. Growth opportunities represent the smallest allocation to emerging opportunities in the cryptocurrency space. This category carries the highest risk, but also the highest potential return within the crypto allocation. Let me walk you through a hypothetical example to illustrate these concepts. This is for educational purposes only and not a recommendation. Consider a hypothetical 52-year-old with $150,000 in retirement savings. Under a conservative framework, they might consider 90 to 95% remaining in traditional investments, like 401ks, IRAs, and conservative stock bond portfolios. 3 to 5% allocated to established cryptocurrencies for long-term potential. 2 to 3% in stablecoin yield strategies for income generation, and 1 to 2% in growth opportunities for upside potential. Now, this is purely hypothetical. Let's look at how the numbers might work in theory. Traditional portfolio growing at historical stock market averages. Cryptocurrency components growing at various rates. Stablecoin strategies earning higher yields than traditional savings. One aspect that interests many investors is understanding how stablecoin yield strategies work. Stablecoins are cryptocurrencies designed to maintain a stable value relative to the US dollar. Educational platforms often discuss how these can be used in decentralized finance protocols to earn yields higher than traditional savings accounts. The concept involves providing liquidity to lending platforms or automated market makers, earning fees and interest in return. Current protocols often offer yields ranging from 3 to 15% annually, though these rates change frequently and carry various risks. For those interested in learning more, Educational resources typically recommend starting with well-established platforms and understanding all risks before considering any allocation. Any discussion about cryptocurrencies must emphasize risk management. The risks include volatility risk. Cryptocurrency prices can be extremely volatile, potentially losing 50 to even 90% of value during market downturns. Technology risk. Smart contracts and platforms can have bugs and be exploited, potentially resulting in a total loss. Regulatory risk. Government regulations can significantly impact cryptocurrency markets. Liquidity risk. Some strategies may limit your ability to access funds quickly. Risk management approaches often discussed usually include the following: never allocating more than you can afford to lose completely, dollar cost averaging to smooth out volatility, using secure storage methods for long-term holdings, having clear exit strategies as you approach retirement, working with qualified professionals who understand both traditional and alternative investments. Timing matters in retirement planning. Those who are 50 plus typically have 10 to 15 years before retirement, which may provide enough time for alternative investments to potentially compound while still allowing for risk reduction as retirement approaches. These frameworks often suggest that earlier exploration allows for better understanding and more informed decision making. However, this must always be balanced against individual risk tolerance and overall financial situations. So let's recap the educational framework that we've discussed today. Consider alternative assets only as a small percentage of your total portfolio. Understand the three-category approach: foundation, income, and growth. Focus on education and risk management above all else. Implement gradually with proper professional guidance. Prioritize capital preservation and sustainable strategies. The cryptocurrency space continues to evolve, and education remains crucial for anyone considering how it might fit into their overall financial picture. The key is approaching any new asset class with proper education, professional guidance, and appropriate risk management. If you're interested in learning more about cryptocurrencies and decentralized finance, consider joining our educational community at Decentralized Masters, where we focus on education and understanding rather than investment advice. Thanks for tuning in to another Decentralized Masters crypto class. If you found this educational content helpful, subscribe, hit that like button. Let me know in the comments below what educational topics you'd like us to cover next. Stay sharp, stay decentralized, my friends, and I'll see you in the next one.